Here's the lie that ruins more portfolios than any bad stock ever could. People think money is lost in crashes because the market falls. It isn't. The real damage usually happens a few minutes later. When a human being opens an app with shaking hands and calls panic a strategy. In 2020, the market fell 34% in just 23 trading days. That's not a normal decline. It's the kind of drop that makes people refresh accounts. In grocery store lines, stare at red numbers in the dark at 2 a.m. and suddenly feel like every sensible plan they ever had was fake. That should offend your common sense. Because most people are raised on the exact opposite story. Stay alert, be proactive, watch the news. And this is where the financial industry quietly flatters you into making expensive mistakes. It sells the image of the engaged investor. Informed, vigilant, always adjusting, always ready to respond. But when the screen turns red, that image collapses fast. Your thumb hovers over the sell button. Dalbar tracked this during the aftermath of the 2008 crisis. Over a 20-year period, the average equity investor earned 1.9% annually. The S&P 500 returned 8.2% over that same stretch. That gap is not a rounding error, it's the price of reacting. That's the trap almost nobody wants to admit. Your biggest financial enemy is usually not ignorance, it's misapplied intelligence under stress. Smart people are especially vulnerable because they build beautiful explanations for emotional decisions. They don't say I am panicking, they say I am reducing exposure. They don't say I can't handle the volatility, they say I am waiting for confirmation. The language sounds sophisticated. And your brain is not neutral in this process. It's not calmly reading a chart and weighing discounted cash flows. Research from Stanford found that financial losses activate the anterior insula, the same region associated with physical pain. So when people say to just be disciplined during a crash, they're pretending the situation is purely intellectual. It isn't. Your nervous system is already flooding the room. Your heart rate changes, your attention narrows. The uncomfortable truth is that most investing mistakes are made by people who thought information would save them, but it won't. In a real panic, information often makes things worse. More charts, more alerts. So before we talk about what actually survives a market panic, we have to destroy the most dangerous myth first. Effort is not always rewarded in investing. Sometimes restraint is, sometimes friction is. Here's the part people hate because the math is humiliating. In a crash, your problem is not just falling prices. Your problem is a shrinking brain trying to manage a shrinking account at the exact same time. Back in 1998, psychologists showed that self-control behaves like a depletable resource. It gets used up, it gets weaker across the day. That means the fantasy of staying calm and making good decisions when it happens is usually fiction. By the time the red numbers are flashing, your willpower budget is already spent. You're using it to regulate fear, to stop yourself from checking the app again, to get through work, to sleep, to function. Financial discipline sounds noble in theory, but in practice it's competing with a nervous system that thinks something is on fire. That's why automation matters so much. And if that sounds harsh, it gets harsher. The second layer is cash, real cash. Not I can sell something and have the money in 5 days cash. Not money that lives in your portfolio wearing a different costume. Cash sitting in a high-yield savings account. Boring enough to be ignored, liquid enough to pay bills immediately, and large enough to cover 6 to 12 months of expenses. That sounds conservative until you run the mental math of a real panic, rent due. Researchers at Princeton found that financial scarcity can reduce cognitive performance by the equivalent of 13 IQ points. 13. That's not a cute productivity dip. That's the difference between operating normally and operating impaired. So if you go into a downturn without a cash buffer, you're not just making decisions under pressure. Now put a second piece of evidence beside that. The Federal Reserve Bank found that households with even modest emergency savings were 2.5 times less likely to make panic-driven decisions during economic downturns. Read that again for what it actually means. The cash did not merely sit there as a balance, it changed behavior. It lowered the odds of fear-based mistakes by 2.5 times. That's the kind of number people love to ignore because cash feels lazy. And that's why this boring pile of cash is not really about returns at all, it's about your nervous system. When you know rent is covered, when the grocery bill is covered, when a job loss doesn't instantly become financial annihilation, your body exits survival mode, your shoulders come down, your breathing changes. This is also where the usual complaint about safe assets misses the point. People say cash drags performance, maybe. But compare that drag to the cost of panic selling productive assets, because you had no buffer. Compare 1 year of lower yield to locking in losses, because your bills were due now, and your only source of liquidity was a falling portfolio. Suddenly the spreadsheet changes. So the evidence stacks in one ugly direction. First, stress depletes self-control, then scarcity knocks off the equivalent of 13 IQ points. Then emergency savings reduce panic behavior by a factor of 2.5. That's not motivational fluff, that's a mechanical explanation for why people with good intentions still make catastrophic decisions. The ugliest part of a crash is not the red number on the screen. It's the moment the damage jumps categories. First your portfolio falls, then your paycheck starts to feel fragile. Then the story you were told your whole life, work hard, save consistently, stay patient, suddenly reveals its missing clause. That story only feels stable when you also control enough assets, enough cash flow, enough optionality to avoid selling in a bad moment. This is the layer almost nobody says out loud. Two families can have the same salary on paper and live in completely different financial realities. One household is funded by labor alone. Every bill, every mortgage payment, every grocery run depends on a single recurring deposit hitting the account on time. The other household may also work, but underneath that paycheck sits a second floor of support. Rental income, freelance retainers, dividends, cash reserves. Maybe a spouse in a different industry, maybe a small business that behaves differently from the stock market. Same effort maybe, but is it the same risk? That difference matters more than motivation, because panic is rarely about intelligence, it's about exposure. If your retirement account is down and your job suddenly feels uncertain, you are no longer making clean investment decisions. You're trying to stop the floor from disappearing beneath your feet. That's when people liquidate long-term assets at the exact worst time. That's when a temporary market decline becomes a permanent wealth wound, and the system is brutally efficient at extracting from people in that position. If all your income comes from one source, you don't really own your time in a downturn. You rent stability one paycheck at a time. Your boss delays bonuses, your hours get cut, your industry freezes hiring, and suddenly your investment account is no longer an engine for the future. It becomes an emergency fund in disguise. Then the penalties arrive. You cash out retirement money at a 40% loss. Add a 10% early withdrawal penalty on top, maybe lock in taxes too, and the machine collects from you at the exact moment when you are least able to fight back. There's a reason the people with multiple income streams behave differently during recessions. Households with more than one stream of income were 4 times less likely to make early retirement withdrawals during downturns. 4 times, not because they all got rich, not because they were posting hustle quotes at 5 a.m., because redundancy changes behavior. A little side cash, a small rent check, a modest dividend payment, occasional freelance work. None of that needs to fully replace a salary. That is the real hierarchy in a crisis. At the bottom are people who must sell. Above them are people who can wait. Above them are people who can buy. Same market, completely different experience. And the dividing line is not effort, it is ownership. Ownership of productive assets. Ownership of alternative cash flow. So when people say to just keep calm and stay invested, that advice is incomplete to the point of being insulting. Calm is easier when your bills are not staring at you from the kitchen counter. Staying invested is easier when your car payment isn't due in 6 days, and your industry just announced layoffs. This is why safe assets can still feel awful in real life. Theory says one thing, lived experience says another. What matters in a panic is not what a spreadsheet labels as prudent, and that's the hidden value of even a small second stream. It isn't only the money, it's the bargaining power. It's the ability to look at a market drop and not immediately translate it into rent, groceries, tuition, or debt payments. It's the difference between checking headlines with curiosity and checking them with a knot in your stomach. Once you see that, the game changes. Crashes don't just reveal who invested well. Most people do not fail in a crash because they picked the wrong asset. They fail because they leave the door open for panic to reach their hands. So the fix is not some heroic mindset, it is friction. Boring, mechanical, almost insulting in its simplicity. Tonight, take your phone out, open notifications, and turn off every financial news alert. Not tomorrow, not after the next Fed meeting, now. Then put one recurring event on your calendar called Money Review. Once a month, same day, same hour. That is when you look at your portfolio. Outside that window, you do nothing. If you want one layer more, choose a single weekly market summary and read that once a week. Not every hour, not every dip, not every red candle. The point is not ignorance. The point is starvation. You are starving the fear machine before it gets fed enough to move your fingers. Because during a crisis, the real product being sold is not insight, it's activation. Emotionally loaded financial headlines spread 6 times faster than neutral ones. So when your screen fills with bloodbath, meltdown, and investors flee, that is not the cleanest signal rising to the top. That is the most chemically effective trigger winning the algorithm. And every time you tap one of those headlines, you are not becoming more informed. You are stepping into a lab experiment designed to raise your pulse, narrow your time horizon, and make long-term plans feel suddenly optional. That is how a 1.5% annual behavior drag gets born. Not from a terrible portfolio, from a terrible information diet. Make the protocol so dull that your emotional brain cannot negotiate with it. Monthly portfolio check, weekly summary, 0 push alerts. If you need to go further, move your investing app off the home screen. Put it in a folder on the last page. Log out after each scheduled review. Add one note to the front of that folder. Bad information consumption costs more than bad timing. You are not trying to become a monk. You're just adding 3 seconds of inconvenience between a surge of fear and an irreversible click. In markets, 3 seconds can be the difference between staying invested and sabotaging 10 years of compounding. The old habit says to check to feel safe. The new system says to check on schedule. So safety does not depend on mood. And there's a second action that matters even more, because it flips a crash from threat into inventory. Open a separate savings bucket completely apart from your emergency fund and label it your opportunity fund. Nothing clever, just that this account has one job: cash reserved for buying assets when markets break. The amount matters less than the separation. If it sits mixed in your checking account, your brain will spend it on comfort. If it sits mixed with your emergency fund, fear will rename every market drop a personal emergency. So separate it physically: new account, new label, no debate. Then write one sentence under it: used only when prices fall to previously decided levels. That sentence is doing more work than motivation ever will. Why? Because when the S&P is down 35%, you don't rise to your principles, you collapse to your wiring. Cornell research on loss aversion shows losses hit much harder, about 2.5 times harder than equivalent gains feel good. So in the middle of a crash, the bargain is visible, but your nervous system experiences it as danger. That's why almost everyone loves the Buffett quote when markets are calm, and almost nobody behaves that way when markets are on sale. In the moment, buying feels like volunteering for more pain. The Opportunity Fund solves that by removing improvisation. You decide while your pulse is normal. You choose the asset, the price levels, and the amount. During the crash, you aren't being brave, you're following instructions left by your calmer self. Here's the part nobody puts on the thumbnail. These 6 moves won't make you look brilliant in a raging bull market. They may make you feel slow, early, even a little stupid. Your friend is posting double-digit gains. Your spare cash is sitting there earning 4.5%. Your opportunity fund looks lazy. Your rules look boring. Your automatic transfers look completely unremarkable. And for months, sometimes years, it feels like you're standing outside the party with a coat on while everyone else is dancing. But that's the price of having an exit. And an exit is worth more than a story. Because when the floor finally drops, the person who kept some cash doesn't need to sell in a panic to cover a bill. The person with rules doesn't have to invent courage at 2 a.m. while staring blindly at a red screen. The person with a buffer isn't trying to choose between protecting the future and paying for real life with the same dollar. They already separated those jobs before the stress arrived. That's the promise here. Not riches, not perfect timing, and certainly not that you'll feel calm. The promise is smaller and far more valuable. When panic hits, you get options. Look at what these moves actually do. None of them require genius. None of them ask you to predict the next crash or rate cut, or whether bonds will finally behave the way the textbook said they should. They don't need a terminal or a secret indicator, or a guru whispering from behind a paywall. They do one thing over and over. They put distance between your fear and your money. They build rails for the version of you who will not be rational. Automation when motivation disappears. Cash when markets turn hostile. Pre-written rules when your body is flooding with urgency. In other words, they aren't built for your best day. They are built for your worst hour. And that matters because your brain isn't defective for reacting badly to market pain. It's doing exactly what it was built to do. Loss feels immediate. Threat feels physical. Red numbers trigger action. That ancient survival wiring is fantastic if the danger is a fire, or a fall, or something chasing you. It's terrible if the danger is a temporary drawdown inside a retirement account. So stop turning old mistakes into a character flaw. You weren't uniquely weak, you were human without enough structure. The answer isn't to become emotionally invincible. The answer is to make fewer critical decisions while emotional. So if you take one thing from this, let it be this: build a financial life that still works on the day you least trust yourself. Keep the boring cash, keep the buffer. That's the real compounding most people miss. Not magical returns, not overnight transformation. Just fewer self-inflicted wounds, fewer forced sales, fewer expensive emotional decisions, repeated for long enough that your survival starts to look like skill. If you're setting up one of these 6 moves first, Tell me which one.